Recall last time in the last part we were observing that the marginal term premium for the third nearby, which is this line, lies below LIBOR, and that the first nearby, I want to note, is oscillating quite a bit. And so the explanation for the difference between the behavior of these lines is fairly straightforward. The first nearby is looking at the spot price versus the first nearby futures price, and they settle at two different points in time, and so there's a little bit of a disconnect there, and the marginal term premium, whatever the disconnect is between futures and spot, the third marginal term premium is just a relationship between the second futures contract and the third futures contract. So the relationship is much smoother. And this is over the period from 1995 through 2019. We're going to look at a few sub-periods, 5-period windows, and note a few interesting observations. Again, this is just kind of an empirical exploration. The data that I'm using is provided by Commodity Systems Incorporated. I really like the way they provide futures data, and it's reasonably priced. And so I would recommend, if you're in need of good futures data, that you consider looking into CSI Incorporated and their data. This 5-year window of 94 through 99, what we observe is a upward sloping futures price. Therefore, for each quarter, we have the third nearby going up. As the price goes higher up, the third nearby basis goes lower. And so you might think there's a pattern there. If you'll notice a similar pattern for the first nearby, but just not as great. If we overlay this pattern with interest rates, what we observe is that as interest rates came down and the third nearby got closer to the LIBOR, the primary driver for that, recall that as the price goes up, the implied dividend yield is going down. And so the combination of slightly declining interest rates combined with a significantly declining dividend yield results in a narrowing of this spread. If we look at the 1999 through 04, the dot-com bubble, the underlying price goes down. As the price goes down, remember the dividend yield is going to go up, and then the price goes up, the dividend yield is going to go down. And again, we see this pattern related to the dividend yield, but also the sharp decline in interest rates is the primary driver of why the basis is narrowing. And so the third marginal term premium, again, is very tight here. As the prices get lower, the dividend yield increases and we get a larger gap. In the 04 to 09 window, when the underlying equity prices rose and then declined into the Great Recession, we observed the basis as we entered the Great Recession and interest rates went to zero. The basis just went towards zero, and and here you see it very clearly in the third marginal term premium. As interest rates decline, the third marginal term premium declines. We have a lot of disruption. If you'll notice all these jagged lines during the financial crisis, which futures markets were under distress, and so. In 09 to 2014, we have a significantly rising price series. Again, in this particular case, the interest rate is above the dividend yield. Therefore, the basis is positive. And the marginal term premium, actually, I said that wrong. The dividend yield is above the interest rate, as we see here. The marginal interest rates were near zero, and therefore after you adjust for the dividend yield, you have a very negative marginal term premium. And we could continue this analysis looking at a rising market with very low interest rates. Here we have interest rates beginning to rise, and we have the third marginal term premium rising, and thus this is clear evidence that the S&P 500 Index Futures market is a carry arbitrage market. So we're going to now dive into some of the quantitative material. Again, we'll cover it very briefly. And you're welcome to investigate the materials that are provided online for more details. We assume arbitrageurs exist. There's no market frictions. Financing is available at the risk-free rate. Short selling is allowed with full use of proceeds. And the futures margin requirements are very small and can be ignored. The carry arbitrage theory model basically says the futures price is the future value of the spot price, where this future value function is based on the all-in carry cost, and it's the future value of the spot. And so carry costs include financing costs and other costs associated with revenues and costs related to the underlying instrument. With the S&P 500, the carry cost is a negative dividend yield because I received the benefit and there's no storage cost. If I'm looking at wheat or soybeans, there is storage cost, and so that's going to provide a significant difference. In a fully arbitraged market, I would expect the fair value of a futures contract after it's marked to market is zero. At expiration, the value initially of a forward or futures contract is zero. For a forward contract, it's the difference between the terminal spot price minus the futures price, or the other way around for a short position. If we considered a carry arbitrage trade, suppose we go short the underlying, we go short the forward or futures contract, we buy the underlying and borrow the present value of the forward price. What you'll notice is by design, I've created a portfolio that has zero value for sure. Therefore, its value ought to be the sum of these cash flows. And if I solve for the futures price, I get the future value of the spot price. Just by way of an example to make sure you understand this, suppose I have a $100 instrument, a half year to go, and the only cost of carry is the 3% continuously compounded base rate. In this case, the futures price or forward price would be 101.51. Notice that it's 1.51 above 100. There's no implication that has anything to do with an expected futures price. This is simply a direct result of carry arbitrage. If I have other carry costs like dividends, storage, insurance, spoilage, I could capture it with an additional term that is added, or I could embed it. Either way. The forward valuation, if I need to value a forward contract at, say, year end, I entered into the contract in July, say, and it's a 1-year instrument, but I need to know its fair value at the end of the year. I could basically just enter an offsetting forward contract. What you'll notice is the resulting future cash flows have no uncertainty. I know what the value of this forward price is at time little t. I know the value of this forward contract at time 0, and I can basically take the present value, and therefore the value of this forward contract is going to equal to this term. So it's very easy to value forward contracts in the interim. In an unarbitraged market, people are unable or unwilling to carry the underlying asset, for example, natural gas. Short selling is infeasible. Short selling a live cow is very difficult. Financing is not available. I learned in China that arbitrageurs are not allowed to access the bank financing. The net hedging hypothesis, hedgers are willing to pay a futures risk premium to reduce the risk. Speculators for a fee will acquire the risk. And so the way to understand this is a simple diagram. If net hedgers are long, in order for the market to clear, I've got to have the same number of speculators. That distance is supposed to be the same as that one. In order for the market to clear, the speculators demand a risk premium. And so the expected future spot price is down here. The equilibrium futures price is up here, and they're going to receive a risk premium by going short. If the net hedgers are short, then the risk premium goes the other way, and the speculators who are net long will receive a risk premium. The futures expectations theory is similar, but it basically says the nth nearby futures price reflects at most the unobservable market expectation of the deliverable spot instrument and perhaps an expected futures risk premium. So we could represent this either as a discrete amount or a continuously compounded amount, either way. For stock index futures contracts in a fully arbitraged market, we would expect, because these are index futures, we'll model the dividend with a yield. Dividends are rather sticky. The dividend yield would rise when the S&P 500 index falls, or the dividend yield would fall when the S&P 500 index rises. And so the pattern of the relationship between the futures price and the spot price, interestingly, when the spot price falls dramatically, we observe that because the dividend yield goes way up, we observe that the futures price is below the spot, and some people think that that's signaling even further declines in the prices, and it does not. The macroeconomic effects, well, equity markets decline often imply interest rates would also be falling. The central bank would try to stimulate the economy. In recessions, we observe that the dividend yield will exceed the interest rate. Term premiums, with the formal definition of a term premium, continuously compounded, is simply the log of the futures price divided by the spot. I find it much more understandable if you substitute in the carry arbitrage result. The term premium is simply dependent on three variables: the base rate, the dividend yield, and time to maturity. The marginal term premium just looks at the relationship between two nearby futures contracts, and again, the base rate and dividend yield and the time to maturity between the two futures contracts. Notice that this time to maturity doesn't change as I move through time, but the previous example, this does. And so you should expect the term premium to vary, but you should expect the marginal term premium's time to maturity not to vary. So in summary, we explored the basics of the carry arbitrage futures pricing. We examined the S&P 500 index futures prices for evidence of carry arbitrage. We find overwhelming evidence favoring that existence. We contrasted the fully arbitraged market with the unarbitraged market. We introduced the notion of term premiums. And the R code that supports this is going to be reading in data, modified data from an external data source. So there is not a public source of this information to my knowledge, but a few samples are provided. In the next module, we'll look at several other futures markets, and we'll discover that many of them they don't reflect carry arbitrage, and the evidence is overwhelming.